Welcome, friends. Today we have on the show Joe Lombardi, founder of Iron Hawk Financial. Welcome to the show, Joe.
Thank you, Bob. Appreciate it, Mark.
Joe, tell us about your business, why you founded it, and what kind of services you offer.
Yeah, I mean, I've been in business for going on 20 years. I started it when I watched my dad fall 30 feet off a ladder and lose a $25 million construction company that I was supposed to take over. And at the time, I had a sister that was born 2 pounds, 7 ounces with alcohol syndrome. And I was 15 years old. I had to drop out of lettered high school sports and go take care of my sister.
Wow. So basically, you are offering insurance benefits to businesses, small businesses?
Well, I specialize in a strategy that saves clients millions of dollars by investing in long-term type of retirement accounts that the wealthy people use.
Right. So what's involved with that? You talk about diversification of taxes in retirement. What's that about?
Yeah, so it's building what's called a rich person's Roth, which I have clients that make over $175,000 a year, and they can't do a Roth IRA. So there's a strategy using Section 7702 of the IRS, which is using overfunded life insurance as a way to accumulate high net worth. I have clients who dump in millions of dollars a year. I have 1,600 clients, roughly close to $1 billion in this type of strategy since I started it. It's a way for you to have an asset that's liquid, tax-free, non-market correlated, sue-proof in some states, divorce-proof in some states, with some of my clients like. It's just a way for clients to beat the 401k, where your money is very illiquid. It's high taxed, it's high feed with 12B1 fees, Class A share fund fee, money management fee, annual account fee. And you don't even see these fees. So if your account got 10%, they just give you 7.5%, and you don't even know the difference.
Wow. So you say it's liquid, so somebody can actually sell off some of the asset, like if any time that you don't, it's not locked in. Is that the idea?
Yeah, it's cash. It's literally
It's
called
cash.
cash. Yeah. So there's a lot you need to know. You need to know what carriers to use, what companies to use, what riders to use, how to structure it. It's not as simple as just, oh, I'm going to buy a IUL or a whole life policy. There's a lot that goes into it. And you want to make sure you're working with a broker, somebody that has access to 200 carriers, because some carriers are better in some states, some are in the others. I'm licensed in all 48 continental states in the U.S., and I know what carrier to use for what purpose.
Right. So say on the business end, the person is owning a business and they want to get involved with this. This is basically so they have a pension in retirement, right? Is that?
Yeah, not just a pension, but a tax-free pension. Yes.
A tax-free pension. So
Yes.
what does that look like for the business owner? I mean, what are they going to do? They're going to be paying into it weekly or monthly. Is that the idea? And is it some type of investment that you're doing? You say it's just cash. I don't understand. How's this working out?
Yeah, no problems. This is one of my two strategies. So what this strategy does is your investment company has been around 176 years, AAA rated, A plus, and you're buying their dividends. You're buying because it's a mutual company. Every dollar you put into the company, they give you a return of premium or dividend. And they start, average 30 years is roughly around 8.98%, no risk, tax free on your money. So you don't have to deal with the 08s. And what a lot of my clients do is actually wait till the 08s come and the 2020s come, and they buy whatever the heck they want at extreme discount.
Okay. 08 and 2020. What are we talking about?
Stock market's down 30, 40, 50, 70%. Real estate's down 20, 30, 40, 50%.
Right.
Equipment.
Oh, you're talking about, you get in when something's down.
Well, yeah, you buy low, sell high, and what the dollar
Right.
cost averaging, if you actually research, it doesn't really pay you more than 3-4% on average. It's not a good strategy.
Right.
High tax, not good return, illiquid, high feed.
So you're talking about 8-9%, which is pretty damn good.
Well, yeah, I mean, and that's tax free. I have a strategy
Tax
right
free.
now. Yeah.
So if somebody were to sell it, they don't have to deal with this capital gains tax.
They don't do it. Ordinary income, federal, state, FICA, Medicare, unemployment, capital, short-term, long-term. It's
Wow.
legally cash.
I mean, this is even good for a person who wants to just invest, right? I mean, if a person is not a business owner, for
Yeah, I
instance.
mean, I have 19-year-old client who has no mortgage, no wife, no kid, and is investing over 1,000 a month in life insurance.
Wow.
Yeah.
That's really interesting because that pays better than any dividend I've ever gotten on a stock. You know, some of them pay dividends, but then if you want to sell the thing, you're kind of locked in, you know, because of this capital gains tax will really eat you up.
Well, brokerage accounts, you're using after-tax dollars to fund it. You're paying tax on the gains that year, and then when you spend the money, you're taxed on. I mean, that's the most highly taxed account. So if you're looking to have a Robinhood, a TD Ameritrade account, that's more for fun. That's what I call people's casino fund, on their phone.
Right. So these are mutual funds that you're uh putting this money in. Is that correct?
No, you're buying a part of a multi-trillion-dollar company, meaning you're buying a block of insurance. That block of insurance actually has a return, which is long-term compounding. So if you have an asset that can't lose, it's money making money on money making money on money making money. I mean, I've seen dividends for some of my clients, in year 20 that are 8 times, meaning they put in 50 grand, their dividends $400,000 in cash.
Wow.
It's crazy because it's all, like I said, it's all you build up. A lot of agents are greedy and they build high commission products, and that's why they get a bad rap. I don't. I lower the fees by at least 50% for my clients and overfund them, where my clients' returns are actually going to be higher than an 8.98%. That's just the average of a base
Wow.
whole
That's
life
just the
plan.
average. Yeah,
Yeah.
this sounds amazingly good. And I mean, is this a really stable investment? I mean, I know people are getting into precious metals because they feel like they're protecting what they have with a physical asset. Would this kind of be comparable to a physical asset, would you say, or
I
better
don't.
even?
I mean, I'm not a huge fan of physical assets because you have Wall Street betting against them. Like
Right.
silver, as example, everyone's like, "Oh, silver should be $1,200 an ounce." Well, it should be, but it's not,
It's
because you
not.
have multi-trillion-dollar hedge funds companies keeping the prices low so that their iPhones could be made for cheap, their Teslas could be made for cheap, and then they're making all the profit on the stocks.
Wow. Yeah. I mean, yeah, this sounds really good. This is something that anybody could benefit from if they knew about it.
Well, it's a very difficult approach to say, hey, your retirement account is a life insurance policy. People look at you sideways. It's
Right.
trying to explain the fact that the death benefit's legally tax free through the IRS, which it is. If you overfund what your term policy, which is what 20, $30 a month is. I have clients who do $10,000 a month. And then all that extra money is just compounding and growing and having liquidity. Plus, you're having long-term care, life, disability, chronic illness, terminal illness, all the things you need, you don't want to pay for. It's all built in the policy, and you're still making money.
Wow. So long-term care is built into this.
Yes, sir. Yeah, you can utilize your death benefit up to $250,000 tax-free annually by accelerating your death benefit. So I
Wow.
have clients who don't even have a wife or kids, and they're using it for long-term care because they don't know what one of the four things are going to happen to them. They're going to live long. They have a tax-free pension. If they're going to die early, it's tax-free benefit to their family or business. They get disabled. It's fully funded. You're 100 years old. You need long-term care. You now have access to millions of dollars in cash, because what happens is with long-term care, you have to liquidate hard taxable assets, whether it's real estate, stocks, bonds, 401ks. Well, all that is very expensive.
Sure.
And it increases your taxable income because long-term care isn't cheap. So
No,
now
not at
you
all.
need to net $200,000, which means you got to pull out $300,000 out of your nest egg or assets to
Right.
net the 200 to pay the home.
Right. Well, say like say my situation, for instance, say if I were to do something like this in my name and my father's name, he's 90. And if he needs long-term care, would that be something that could be applied because it's in both our names?
Yeah, so for a 90-year-old, he's over the age.
Okay.
85 is usually the max. If it's
Right.
something you wanted to do, I do have children that use their father or mother's assets to do a strategy like this, either on their life or even their kid's life. Maybe you have a child who's 30 years old or 40 years old. So
Right.
that's going to be better than, let's say, if you're 50 years old, because it's based on your age, sex, and health rating. So if
Right.
you're super healthy and older, that's fine. But if you're young and healthy, it's really good. I mean, the cost of insurance is so small that we could overfund it even more than somebody who's
Right.
50 years old.
So this would be good for somebody like me then.
Oh, absolutely. I just did a
Yeah.
57-year-old before I got on this meeting with you.
Wow. That's amazing. So, I mean, you offer different types of insurance though. But
Well,
this is
that's
kind of
just my
like an
main.
umbrella coverage.
Yeah, so that's my main strategy, is to help build a financial foundation, because not just my father fell 3 stories, lost a $25 million restructuring company in the hospital for 2 years. My mother died at 52 years old, cirrhosis of the liver. My grandmother had a stroke, led to dementia. She lost 4.2 million to Ludlow Nursing Home in Fairfield, Connecticut, across from Sacred Heart University. So, like, my family was very good at building wealth, but they weren't good at protecting it. So that's
Yeah.
my first strategy, is saying, listen, build a foundation, save yourself a boatload of money on taxes. Fortunately and or unfortunately, I meet a lot of people with IRAs, 401k, SEPs, simples, pensions, profit sharings. So I have a strategy to roll that into a company that's been around since 1848, third oldest life insurance company in the world, A plus rated. And the last 10 years in the strategy has averaged 14.67%, no risk. Can't
Wow.
lose.
That's high. That's almost unheard of, right? I mean, we don't hear about that.
Well, the
I,
wealthy people are the ones who do it, and they leave the peasants or the uninformed to just, oh yeah, have your what's called a naked 401k. And when the market drops 50% and you gain 100%, you made nothing. While they,
right.
when the market drops 50%, they lose nothing. And when the market gains 100, they doubled their money on the exact same investment.
So how did you come across this type of method? Just a lot of research or
So I've worked at Northwestern Mutual, MetLife, Guardian, Mass Mutual. I've been working at the top, and I've always been a top producer. So I won 27 industry awards. I was just on the cover of the top 40 advisors in the country under 40 years old. And what I did is I always found the top producers, and I mimicked them until I became the top producer at these companies.
right,
So there's not inventing the wheel. It's finding out what the wealthy people in Manhattan are doing. Why are they
right,
doing it? I want to figure out what the millionaires and billionaires are doing, not
right.
what my plumber friend Steve's doing because he heard some crypto thing that FTX was a great investment and now he has no money. I want to follow what the wealthy people do. So I
Yeah,
take a super white collar strategy and I bring it to the blue collar market.
right. Yeah, I mean, there's different ways you can invest. You can invest in physical assets. You can invest in the stock market. Physical assets have certain drawbacks, like you said, they're being artificially suppressed. Plus, where are you going to store it, right? If you have precious metals, you got to store them somewhere. You got to pay for storage. If you store them in your own house, there's always a risk. Stock market, I'm just really leery about it. I suppose it just depends on what companies you're invested in. But then there's that capital gains tax, which is it's like you're locked in, unless you sell a little bit at a time. But even still, you're taxed, no matter what. It's just this really sounds amazing to me. And you talk about 14% interest. The last time I heard about that was probably in the 80s. I managed to purchase a CD back then, and I made a decent amount of money at that time. But that's really unheard of, right? In this day and age, in most type of investments.
I mean, it's all relative to inflation. So if
Right,
inflation's running at 10%, you're getting 11%, you're really only making one because the value of your dollar is being decreased by the cost of gas and the cost of property
right,
taxes, the cost of electricity and food. So it's the strategy I'm using. What they do, the second strategy is they basically use what's called contracts, calls, puts, stops, warrants, futures, and they bet on both sides of the market. So if the market were to go down, they make money, right? That's why you have a 0% floor. You can't lose. And if the market goes up, you make 310% or whatever the market does. So there's a no charge one and there's a 1% charge one. And I usually offer the 1% charge one because all that 1% does is you actually get something for your fees. You're not buying some guy in Manhattan a Ferrari on your retirement account to literally do nothing. to manage your money. They don't manage anything. So it allows my clients to buy, basically, if the Red Sox are playing the Yankees, they have money on both teams. So if
Right.
in this example, the market goes up and the Yankees win, right, you get a multiplier, you get 310% or whatever the fund did. Whether it's US fundamentals, global balance, Morgan Stanley, there's tons of different options, tons of different carriers. And then if the market goes down, the company makes the money, right? And so you have only a 1% loss, which was your cost for the contracts. So it's a very safe way. It's taking a very confusing thing that the average American doesn't know, that all the wealthy millionaires and billionaires know.
Right.
And again, I never touch your money. You never write a check to Joe Lombardi. You never write a check to Ironhawk Financial. You don't have to, I'm not going to made off with your money, as they say. So it's very safe. I only represent A-rated companies, and I move money from you to that A-rated company directly. So it's a safe transaction, but I'm doing the due diligence. I'm researching all the products, all the different options. And what I'm doing is I'm taking an investment and an insurance product, merging them together, and you're getting the best of both worlds.
Right. Right. So let's say, okay, let's say, for instance, I want to get involved. Is there a minimum investment to get started?
So my first strategy is $200 a month, very, very low if you want to start building a rich person's Roth. On the rollover side, it's $25,000.
25,000.
I mean, there are other carriers that do 10, so I mean, it could be as low as 10, to be honest, but 25 is usually the industry average.
25 what?
Thousand.
A month?
No, total, just one time rollover.
One time.
Yeah, so if you had an
could take a
IRA
lump sum and throw it in and you're good.
And you're done. Yeah, the thing's going to compound and grow. You're going to get 2 to 4 times your money in 10 years with no risk.
And if you want to add to it, dump another lump sum,
you do another. You just keep laddering them or buying more than one.
Right.
Yeah.
Right. Yeah. And then it's like, say, for instance, you say it's like cash, so you can extract some at any time. What person would call you? And
well, there's two strategies, right? The tax one is the one that you're going to contribute on a monthly or annual base, because you're going to keep it your whole life. That's why they call it whole life. You as long as it's enforced when you die, if you put in 10 million, took out 8 million, put back 3 million, take out 8 million, no matter what you do, as long as you die with $1, you are your own bank. That's my book on Amazon called Being Your Own Bank by Joseph Lombardi. It teaches you very simply, a 25-page book. I keep it stupid simple, KISS. And it just teaches somebody who has no foundation on finances, economics, taxes, that really is lost, that maybe their job is a psychiatrist, their job is a solar guy or a roofer, and they don't understand this stuff. And I try to make it as third grade level as possible.
Yeah. So what's the name of that book again?
Being Your Own Bank on Amazon.
It's on Amazon.
It's Kindle. Yeah, it's an audio book. It's $4.99. I think I make $1 every book. I wanted to give it away for free. They won't let me. So.
Yeah. Yeah. I've been thinking about my future and what I want to do. I'm not really too crazy about the stock market. I have gotten involved in precious metals, but like you said, they pretty much kind of stay where they are. They don't move much.
They never move. The millionaires and billionaires make more money betting against it. Because think about it, if you put in $1 million and they put in $100 million, who's going to have the power to move the market?
Yeah.
So you're fighting a fight you can't win. I own zero gold, precious metals, because I worked in Wall Street. I know what they're doing, and they're looking at the bigger picture of, I can make way more money on Apple stock, Tesla stock, Verizon stock than I can on if I bought a metal coin. And then people think that hedges you in case the apocalypse. But if the apocalypse comes, the only thing that matters is food and bullets.
So right, you can't eat silver and you can't eat gold.
So the whole logic of it, I sort of understood it, and I bought into it a little bit until I really I was working in Manhattan, and I talked to a lot of these millionaires and billionaires at the parties and the top producers, and I've always been one. I've been $1 Million Roundtable since 2008 every single year. So I get invited to all these different events throughout the country. Throughout the world, actually. And, they laugh. And it's sad that they're laughing, but they laugh because these people are ignorant. And we're not taught any of this in school. We're not taught any of this in college. We're taught how to be an employee. We're taught to be a good little boy and raise your hand. We're not taught these things that the wealthy know. And you think the wealthy put their kids in public school, right? No. They teach their children what to do and what not to do, while the public's being taught how to be an employee, how to trade out time, time for money, or hours for money. You only have so many hours in a day. How could somebody like Bezos make $1 billion when he goes to the bathroom?
Yeah.
But yeah, we it's taking, and that's all I wanted to do. I realized that I'm not smart enough, and I don't think many people are, to reinvent the wheel. So, but I am smart enough to do is copy what the wealthy people are doing.
Yeah,
And
sure.
I've been doing it for a very long time.
Yeah.
I'm very, very successful. My wife hasn't worked in 12 years. I have 3 kids. I coach. I get to live a very carefree life. And I've never lost a client $1 in my career, and I never charged a client $1 in my career. The
Amazing.
companies pay me a finder's fee for every dollar I bring them, as long as it's suitable and it makes sense to the client's goals, their time horizon, what they're trying to achieve, and what the company has to offer. And of course, they review it, because I have a 5-star rating on Google, A+ rating, Better Business Bureau. My goal is just do the right thing. And I try to explain to clients, you have to not be with the government. I don't want to sit here with my tinfoil hat on, but they're a monopoly. I mean, why
Yeah.
are you going to put your money in something where they slap your hand like a little child if you
Yeah.
take your money before you're 59 and a half,
Oh,
and they
absolutely.
charge you 10% to access your own money?
Yeah.
Can you
It,
imagine putting your money in a Bank of America, and every time you paid a bill, they took 10% out? I mean, it's
yeah.
insanity. Nobody would bank there. But
So,
people dump in trillions in 401ks, and they don't understand what they're doing.
wow. So, I mean, you're actually saying that people are better off in the stock market with good companies that they are with, say, gold or silver?
If you're conservative, which what I found is somebody that buys gold and silver is very conservative. They're very nervous. They're usually scared of their hard-earned dollars going away. So I mean, I believe that, historically CDs have outperformed gold and
Yeah.
silver. Yes, there's a month where gold's up 50%. There's also a month that's down 80%.
Well,
So
I mean, it's not really, I don't think people are looking for performance. They're looking for stability,
safety.
like you said.
Well, that's that. I would look into an annuity. I mean, there's fixed guaranteed annuities that are paying way more than gold. I mean, right
Yeah.
now I have annuities paying 6.1%, no risk, can't lose,
Right.
and they'll pay you
Yeah.
6.1 on your money. Which, you compare that to gold, Lipper averages 1, 3, 5, 7, 10 years. It's higher. So
Yeah. Well, you're talking about 14%. There's not a lot of risk in that either, right?
there's
I
no
mean,
risk in the 14. That's called a single premium deferred fixed immediate annuity. See that 10 times fast, but. And that's through A-rated companies like Nationwide, Silac, National Life Group, Americo, very solid companies that have been around hundreds of years, that are A-rated, and you're buying a promise from them. And when you buy a promise from an insurance company, you want to make sure, A, what's their track record on, right? What have they done in the last 10 years? Are they financial hardship? Are they public or mutual? That's a lot of public doesn't know what that means, right? Are they owned by like the stock market, or are they still a mutual company? There's a huge difference in those two companies.
okay,
One
what's
is,
the difference? Go ahead.
well, a mutual company is owned by its policy owners.
Right.
A stock company is owned by its policy holders, stockholders. So inside of a stock company like MetLife, they went public in 1999 because they were selling universal life as a whole life or retirement account. And what happened to interest rates? They got smoked by 10, 12%. So your premium of $100 for your life insurance policy ballooned to $800. And you're like, what the? Because the profit in the interest rate environment is supposed to pay your premiums. That profit wasn't there. So then that was left on you, the consumer, to pay the difference. So there was a class action lawsuit. They got sued, and class action lawsuit won. And so all MetLife did is say, okay, well, we were mutual. Now we're going to go public. So what did they do? They gave everybody stock, and they didn't pay one penny, but now they lost their shield. So you having a mutual fund is having a shield around your money, where that company can always do an IPO. And it also means lower cost of insurance, higher returns, because you don't have a stockholder taking 10% of your profit, and you're first in line, not second in line. So it's way better deals, way better returns, lower
Right.
fees.
Right.
It's very important to not just do it willy-nilly, but actually research what carrier, why am I doing this? What strategy, why am I doing this? What riders or add-ons, why am I doing this? So you can make a very educated decision, not because some random guy named Joe said so, but because you understand it's tax-free, it's liquid, it's non-market correlated, sue-proof, it's divorce-proof, has disability on my contributions, long-term care, has chronic illness, terminal illness, has all the things I need to protect my family, and I'm making money.
Wow, that's amazing. So, all right, you say it's liquid. If somebody say I'm invested in this and I want to sell some of it, I call you. Do I call you? Hey, Joe,
Yeah.
I want to sell.
Yeah, Joe, I found this, you don't even have to tell me why,
Yeah,
but
sure.
most of my clients say,
Sure.
hey, but they used to buy real estate. So imagine earning 2 streams of income on $1, right? So what a lot of my clients do is, let's say I have $1 million in there, we can go down to 100 grand. It doesn't matter the amount. And what they do is they leverage it by a third party collateralization. These are all things you can Google, do your own research on. They third party collateralize their life insurance. So why would they do that instead of taking a direct loan from the insurance company? Well, they would do that because the policy doesn't know there's a loan on it. So what does that mean? Well, if you get a third party to leverage something, the policy doesn't know there's a loan. So you're still earning all your dividends. You're still making full comp on your money,
Right.
even though your money's sitting in a rental property across town, all of it. So now that rental property's earning you what, 8 to 15%? So now you have the rental income pays back the loan that you took through the third party collateralization, and you're now earning the profit on your life insurance company, the profit on the rental company, minus the one loan that you have as a third party collateralization, which is usually lower, or you wouldn't do it, than the profit you're earning inside your whole life plan. So what all the wealthy people do. Look, I mean, there was an article just written on Elon Musk. He says, I don't make any money. He doesn't. He makes $0 a year. He has his company funded, leveraging through life insurance to buy whatever he wants, and then goes to the bank and say, hey, I got all this money, whether it's in stock or life insurance, give me a loan.
Right. Sounds like magic to me.
Well, it's being your own bank. It's knowing how everything runs and works and why, and having a rhyme to reason, and understanding that it's a long-term play. I mean, you're underwater in a whole life plan for the first 5 years.
Yeah.
Meaning you don't have access to all your money. So it's knowing that it's a long-term. If people are looking for a short-term thing, then I'll put them in a CD, or I'll put them in a super low interest rate annuity, a risk annuity. So
which is what, typically like 5 years or something like that?
5 years is 6.1 right now. No risk. But it's taxable. And that's what people don't understand, right? If I offered you 2 jobs, one where you made $1 million a year, but you had $500,000 of expenses, or the other job where you made $700,000 a year with no expenses, which job would you want?
Sure, the 700,000.
Well, most people look at their 401k. I had a client that came to my office with $1.1 million. Like, look, I'm a millionaire. I'm like, no, you're not. You're holding $500,000 that the government's going to steal from you when you take distributions. So you're about a 600,000-aire. Sorry to burst your bubble.
Well, it's the same with stocks. I mean, you want to sell it, you got that capital gains tax,
Yeah.
Joe, yeah, we definitely, where can people find you?
My website's ironhawkfinancial.com, www.ironhawkfinancial.com. One of my cell phones is on there that uses a direct line to me. I have a team. So my vice president, Steve, will go to him, it'll go to Andrew, it'll go to Tim or somebody else. But I do have a presentation on YouTube, which I'll have all my socials up and running in about 2 weeks. Which you go to YouTube, type in People's Conductor, Ironhawk Financial. It walks you through a 36-minute YouTube video on my presentation. But it's just knowing the facts, and then it's fact checking everything I say. I'm going to use why use life insurance. I mean, if you go to Forbes, if you go to Forbes or just go to Google, types in Forbes rich person Roth. So I have to type in, brings 2 articles which teaches you about this on Forbes, that this is what wealthy people do. And there's a lot of information on it, but people, if they don't understand it, they don't buy it. So they'd much rather buy gold or silver so you can understand that, oh, that's valuable. That goes into an iPhone, and that goes into a computer, or that goes into an ion electric battery for a car. But it's being mined so much, again, by children, by the way. Many of tens of thousands of children are dying by all these electric vehicles, but they're, and they think that it's a good strategy. Again, I'm not here to poo-poo on gold and silver. That's not my shtick or anything. But when you can compare something, I'd rather give my money to a life insurance company, because when you give them $1, they actually have to hold it, than give it to where for every dollar they pull in, they lend out through fractional lending $20 for every dollar they bring in. That doesn't seem like a long-term good strategy for me, knowing there's people that don't pay their bills in this country. So it's a very safe fund. That's why all the multimillionaires put it there. It's almost better than an FDIC insurance because they have reinsurance companies backing them. Every life insurance company has to put a percentage of their profit into a reinsurance. So if a
Right.
company fell like AIG did in 2008, how quick were they bailed out? Oh yeah, within a week. And how much did clients lose? $0. They actually got mad that all the top executives got free jets and
Yeah.
bonuses. And
Yeah.
remember
Yeah.
that?
Oh
And
yeah.
so literally, do you hear about that with any type of investment company? No, because Merrill Lynch had to get bought out. That's why they became Total Merrill. Investment companies are actually lower risk, or excuse me, lower rated than insurance. Insurance company is the safest place to put your money. Period. It's not
And
even
who would have
close.
thought, really?
And doing it inside of a strategy that's keeping up with inflation, if not passing inflation, while keeping liquidity, it just makes sense to wealthy people
Absolutely.
who don't need the risk.
Absolutely. It's perfect. Okay, Joe. This is packed with information. This is like a godsend, really. I mean, people listening to this, I mean, it's very enlightening. I've been little bit perplexed, a little bit indecisive about what to do. Stay on the line for a moment after we end this. I want to talk to you a little bit. But thanks for coming on. This is really, this is great. Absolutely. I
Well, I
appreciate it.
appreciate you having me on, and anybody wants to reach out to me, like I said, I don't charge a penny for my time. I'll give you all the information you need, and I'll have you do your own due diligence and research if you don't think that what I'm saying is correct.
Okay. Thanks a lot, Joe.
All right, have a wonderful day. Thanks.